Welcome to this explainer. Today, we're taking a really fascinating look under the hood of modern investing. For decades, the golden rule of wealth building has been pretty simple. Park your money in a low-cost S&P 500 index fund and just let passive investing do the heavy lifting. But what happens when that supposedly safe, highly diversified strategy morphs into a concentrated, debt-fueled bet on just a single sector? In this explainer, we're going to dive into a really compelling analysis of the systemic risks forming in passive index funds right now, basically all due to the massive AI boom. And more importantly, we're going to explore a structured, multi-step strategy derived from our source material that's specifically designed to protect your wealth while still capturing the upside. All right, let's dive into this. The analysis kicks off with a startling reality that really challenges conventional passive investing. Right now, 40 cents of every single dollar you put into an S&P 500 index fund doesn't go to 500 companies. It goes to just 10 mega companies. We're talking about the absolute giants: Microsoft, Apple, Alphabet, Amazon, Meta, and of course, NVIDIA. So yes, you are technically buying a small piece of 500 companies, but the weight of your investment is incredibly top-heavy. And this extreme concentration is exactly what's causing some really seasoned investors to completely rethink their portfolios. To navigate this concentration risk, the source outlines a multi-pronged roadmap. We'll be looking at 1. The S&P 500 AI bubble, 2. The flaw in equal weighting, 3. Global market diversification, 4. The overlooked AI zone, and 5. Hedging with gold and cash. Okay, let's jump straight into Section 1, the S&P 500 AI bubble. We really need to break down what exactly is inflating the top of the S&P right now. In standard index funds, they use what's called market cap weighting. That just means the more valuable a company gets, the bigger its slice of the pie becomes. And right now, NVIDIA alone commands a staggering 7 to 8 cents of every dollar invested. Why? Well, because the top tech companies all share one very specific trait. They're all spending aggressively on artificial intelligence. And this creates a massive debt-fueled feedback loop. Think about it. Bigger AI companies attract more passive investment simply by being big, which pushes their stock prices even higher, which then gives them an even bigger share of the S&P 500, which in turn attracts even more money from everyday passive investors. Actually, the source notes that without all this massive AI spending, the data suggests we might already be in a recession right now. But here is where the math gets, honestly, incredibly speculative. To actually justify their current sky-high valuations, these top AI companies would need to pull in a staggering $2 trillion in revenue. Just to put that into perspective, that is more than the combined 2024 revenues of NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta. And the spending to get there? It's staggering. The analysis points to figures like OpenAI's Sam Altman stating he's willing to commit $1.4 trillion to AI infrastructure. Meanwhile, his company currently makes roughly $13 to $20 billion in yearly revenue. So the absolutely crucial takeaway here is that these top companies aren't being valued on what they earn today. They're being valued on a massive, highly leveraged expectation of what AI might deliver in the future.
Moving on to Section 2, the flaw in equal weighting.
Seeing this bubble forming, you might be thinking, okay, easy fix. I'll just change how the fund is balanced. A pretty logical workaround to that 40% concentration problem is an equal-weighted fund, where every single company just gets a flat 2% slice. Problem solved, right? Well, the source details why this strategy actually falls apart in practice. It essentially forces a negative momentum approach. When a company takes off, let's say Tesla goes on a massive run, the equal-weighted fund is forced to automatically sell those winning shares as they rise. Why? Simply because it has to maintain that strict 2% balance across the board. It then takes that money from the winners and buys the companies that are underperforming, the losers. So you're constantly trimming your winners to buy losers. Plus, doing this requires constant trading, and those high trading costs silently eat away at your returns. Because of this, the strategy concludes that standard S&P 500 funds are still necessary to capture natural market momentum. You just shouldn't put all your eggs in that single basket. That brings us to Section 3, global market diversification. Because keeping all your money concentrated purely in the US market is so risky right now, we look to the first active step in our solution. The danger of home bias is best understood through the analogy of a layered cake. The cake itself, the entire global stock market, never shrinks. It's always there. But the thickness of the layers, which represent different countries, is constantly changing. For example, back in 1900, the United Kingdom was the undisputed financial capital of the world. They held 24% of the global market. Investing anywhere else seemed foolish. But things shifted. By the late 1980s and 90s, Japan's tech and auto sectors completely dominated, and a lot of folks thought the US was falling behind. Today, of course, the US is on top. This historical timeline proves that economic dominance always shifts. No country stays on top forever. And that's exactly why the strategy suggests utilizing low-cost global funds, like VWRP or Fidelity's FSPSX. These funds instantly expose you to thousands of companies worldwide. If US dominance ever starts to fade and another region surges, a global fund automatically adjusts the layers of your cake for you. Let's look at Section 4, the overlooked AI zone. Now, the next pillar of the solution isn't about running away from AI. It's about finding the actual real value in it. The source breaks the stock market down into a matrix of 4 distinct zones to show us what passive investors are missing. Up in the top left, we have the crowded zone. These are the large-cap, highly valued companies like Nvidia and Meta. Everyone is already there. Top right is the defensive zone, fairly valued large caps like Walmart. They're reliable, sure, but they aren't high growth. Bottom left is the speculative zone. These are small caps with sky-high valuations built purely on hype. Think meme stocks or fleeting fads. The strategy explicitly avoids both the expensive crowded zone and the highly risky speculative zone. Instead, it zeroes in on the bottom right, the overlooked zone. These are small and mid-cap companies. And the key here is they aren't trying to build expensive AI foundational models from scratch. Instead, they are practically applying existing AI to solve real-world problems right now, all without carrying billions in debt. To really understand why the overlooked zone is such a powerhouse, the source uses a fantastic gas station analogy. Think about it. As foundational AI models from massive competitors like ChatGPT, Gemini, and Claude continue to improve, they're all becoming quite similar in capability. They're essentially becoming interchangeable commodities. If one gas station sells premium gas for $3 a liter, and the one right across the street sells standard gas that does the exact same job for $1.50, what happens? Users are simply going to choose the cheaper option. A massive price war is literally inevitable among the big AI builders. And what this means is the real profits won't stay with the tech giants who spent billions developing the models. The value will naturally flow down to the smaller businesses, the underdogs, who are smartly and cheaply using that very technology to improve their own products. Finally, we reach Section 5, hedging with gold and cash. The final 2 pillars of the strategy are all about preparing for the massive instability that major technological and economic shifts inevitably bring. Historically, when technology changes this drastically, power and currencies often shift right along with it. That's why the analysis points toward hard assets, specifically gold. And there's a massive institutional shift happening right under our noses that you might not be aware of. As of 2025, Basel III banking regulations completely reclassified gold as a Tier 1 asset. In simple terms, this means banks can now treat gold exactly the same as cash or U.S. Treasuries on their balance sheets. Because of this rule change, major institutions like Bank of America have raised their reserve guidelines for gold from 20% to 30%. That 10% jump is creating massive, undeniable institutional demand for an asset that you literally cannot print. You couple this with the fact that China and the BRICS nations are actively building a gold corridor to facilitate international trade, potentially bypassing the US dollar entirely, and you have a very strong case for allocating a strategic, fractional portion of a portfolio into physical gold or gold ETFs. And lastly, we look to the ultimate safety net, a staggering $347.7 billion. That is Warren Buffett's record-breaking cash stockpile as of the first quarter of 2025. Buffett is the ultimate value investor, right? He only deploys capital when the price actually makes sense. The fact that he is hoarding this much cash strongly suggests he doesn't see justifiable valuations in the current market, which is so heavily skewed by this AI frenzy. The analysis strongly recommends mimicking this approach. Holding a larger cash reserve does 2 vital things for you. First, it protects you from having to sell off your investments at a loss during a personal emergency. And crucially, it gives you the dry powder, the buying power, to step in and buy high-quality assets at a steep discount when the market eventually does correct itself. So what should you really take away from all this data? The ultimate lesson of this explainer definitely isn't a call to panic, and it's certainly not telling you to entirely abandon the S&P 500. It's about recognizing that the landscape has fundamentally changed. By continuing to hold some S&P 500, you still capture the upside if the AI boom truly delivers on its massive promises. But by diversifying into global funds, hunting for real value in overlooked AI appliers, and strategically hedging with gold and cash, you essentially build a fortress around your wealth. You stop trying to predict a completely unpredictable market. Instead, you have to ask yourself, are you purely gambling on an AI miracle, or are you actually preparing for both outcomes?